So what I'm about to tell you is actually a real story that happened to me quite recently. I had my fingers burnt by a financial advisor through a company, but I managed to wiggle myself out of it. This video is about me taking you through the story, but also showing you the analysis and projections in a data-driven way using PowerBI. So stick around for that. Hi, my name's Kevin, and if you're new to this channel, I am a civil engineer turned data scientist in the fintech space. Now, before we just jump into the analysis, I want to give you a bit of the backstory. But before we even do that, just a bit of a disclaimer. I'm not here to badmouth any companies or financial advisors, so I won't be mentioning any names, but I just want to bring awareness to this whole financial advising industry and what you should watch out for as well. Okay, so now that we have that out the way, let's rewind back to 2.5 years ago when, through a friend, I was introduced to this financial advisor. Let's call him Tom, all right? Because we're gonna have Tom now and then a bit later on Jerry. So just Tom and Jerry, just to protect names and identities. I was approached by Tom, the financial advisor, and me and Tom had a couple of introduction meetings, as they do, and he explained a whole range of products to me from this specific company, and I decided to take out with them a retirement annuity, life cover, and also income protection. So those are the 3 products I decided to go for with Tom. So Tom gave a whole bunch of verbal promises if I do go with him, and those are optimizing my product range, because if I take multiple products with them, it sort of, they optimize each other, right? Then there was cash backs as rewards for sticking around for, well, the duration of my career. So then there was a 0.25% charge of financial advice fee. Maybe I should explain this a bit more. So I believe the range in South Africa is minimum they can charge financial advisors is 0.25% and the max is 3%. So he also said, okay, I'm gonna do the lowest because I believe in giving you value, you know? So 0.25%, and I was like, what a guy, amazing. And then he also said for my retirement annuity, the product has an average annual return of 13%, of which later on I were to find out that that is not the case at all, but we'll touch on that later. And maybe just a bit of context on this. So if you're not a very savvy investor, then you should know that 13% is relatively quite good on a financial product. The last promise was really just the cherry on top, which was whatever my total growth value is at retirement with my RA or my retirement annuity, I will get back 1.5 times that. I was sold. I was like, okay, this seems like a good decision to make. And so I took this product range. Just to remind you, it's the retirement annuity, the life cover, and it is the income protection. So now we fast forward on for about 2 years, and it was December 2024 festive period when I decided to do a bit of a data sort of driven deep dive into understanding my products that I have, the possible returns I'll be getting, just the whole study on that. And that's when I was basically red pilled and just found out the shocking truth. So now also during that December period, I took some time to just increase my financial knowledge, which led me to actually asking Tom for the EAC report, or the effective annual cost report. Just an FYI, if you're taking out products with any financial advisor, always ask for the effective annual cost report, just to understand what the fees are for whatever products you've taken out. So now, without further ado, let's take a look at my EAC report. So now, taking a look at my EAC report, you can see a breakdown of how we get to the effective annual cost right at the bottom of the first table. And basically, any sort of financial firm that gives out products, a lot of them have what we call early exit fees, right? And that's why you'll see that, for example, the next 1 year it's 17.7%, the next 3 years it's almost 10%, the next 5 years it's 7%. So it reduces with time, but basically the earlier you exit out of this, the higher cost to your total investment, right? And that's just to explain the early exit fees. Then I just want to draw your attention to the bottom right cell, the 3.27%, and we're just going to be analyzing this later in Power BI, these two percentages, but basically the 3.27% is if I did not take any other products with this company, said company. Maybe I just had my RA, so this would have been the effective annual cost, 3.27%. But because I took out the life cover and income protection, this then reduced to 1.19%. All right, so just keep those two percentages in mind, because we're going to be doing a bit of a deep dive long term how these percentages actually really affect your investment. So now this 1.19% doesn't seem large at all. Like, okay, that's just 1% of my investment. That's not too bad. Wait till you see later what it means. So now after seeing these fees on the EAC report and doing my deep dive, I was actually shocked at how much this was hampering my investment, and so I had to take action. What I had also realized at the time was that by the end of 2024, I would come to realize that 2024 was one of the best investment years in the 21st century. So I have a tax-free saving account as well with another company, and they did extremely well with really low fees, whereas my RA with this specific company during that 2024 period did not do so well, which made me also investigate this 13% return that they spoke of. To my shock, let's go look at what we call the fact sheet. So what we are seeing now is just a snippet from the fact sheet of this fund that my RA was under, and I want to draw your attention to the second last line. This is since launch, what was the average annual return, right? And that 6.06% is the actual fund, and they are just trying to outperform their benchmark, which is 5.41%. So in theory, doing well against their benchmark, but this 6% was not even half, less than half of the 13% that Tom told me about. And again, we're gonna use this 6.06% in Power BI and see what does this return mean over the long run. 6% return per annum. So now I was honestly just shocked by all of this, really upset actually that I just lost out on the last 2 years investing my funds in an underperforming fund basically. And then I decided to undergo what we call a Section 14 transfer, which basically allows you to transfer your RA from one fund to another. And this is basically just a clause under the Pensions Funds Act in South Africa. So I guess the disadvantage of not using a financial advisor to handle your finances is you have to learn about the regulations and the acts and the clauses and all that for, I guess, the whole financial game. And I came to learn that for your retirement, you have to undergo a regulation called the Regulation 28 compliance. And basically this is for your RA and means that you can only have a maximum of 75% of your retirement savings in shares, a max of 25% in property, and 45% in international assets. So now I'm just going to share a breakdown with you on the returns and the fees of like the different funds that I chose with this new company. So I basically maxed out the 45% limit by investing into an S&P 500 tracking ETF. And as you can see, when we talk about the returns, you can go through the different ones through months and years, but with the since inception, so that's the average annual return, and we can see that's 17.1%, and that's over 10% more than what I had with Tom, right? Oh yes, and by the way, now we're dealing with Jerry. So this is Jerry and his investments, just to clarify. Again, Tom and Jerry. So now let's get back to analyzing Jerry's different funds that I invested into. Oh yes, and by the way, when you're also purchasing from a certain fund, ETF, a stock, whatever that may be, the investment firm you are purchasing this through usually charges a fee, but you probably knew that already. And where you can see this is, again, the fact sheet, and what you should be looking for. You have a total expense ratio and you have a total investment cost. So I always look at these before I decide on investing in certain funds or products or whatever that may be. Okay, so now back to the analysis of Jerry's different funds that I invested into. Cool. So with the fees, you'll see that the total expense ratio is 0.2%. There are no transaction costs. Therefore, the total investment charge is 0.2% again. And just for some clarity, your total expense ratio plus your transaction costs equals your total investment charge. All right, so now we're done with the S&P 500 tracking index. Let's take a look at, I also invested in a JSE Top 40 Index Fund. So that's the average annual return. You'll see that's 8.8%. Again, not as much as the S&P 500, which tracks the top 500 companies in the US. This one is more local. If you're in South Africa, the top 40 companies on the Johannesburg Securities Exchange, and this gives 8.8%, still higher than Tom's fund that I invested into. If we look at the fees on this, total expense ratio is 0.47%, and your transaction costs are 0.15. TIC is 0.62. Again, not as low as the S&P 500 tracking ETF, but still much lower than Tom's fund, right? If we look at the last one, which is a bond fund that I invested into, the average annual return was 9.4%. Now, if we look at the fees, total expense ratio 0.42, a very low transaction cost charge of 0.03, and the TIC 0.45. All right, what is key for me here is that all these are playing around that 0.5% or lower. And that is what I basically look into when looking at different investments, that I try to keep my fees 0.5% or lower than that. So now let's look at the EAC report of Jerry's different funds that I decided to take out. Again, EAC is effective annual cost. We see here, this was, again, it's very similar to the previous one, next 1 year, 3 years, 5 years, but you'll see that fee is much lower than Tom's fund, right? And I mean, if I want to leave this fund, this won't cost me much if I see something better on the horizon or whatever that may be, doing another section 14 transfer. So that total EAC is 0.5, and this is less than half of what the previous one with Tom was. So again, Tom and Jerry, looks like Jerry is much better. So maybe just touching again on Jerry's different funds and their average annual returns, also taking into account my percentage allocation to each. So keep that in mind, 13.18%. We're going to look at this in Power BI. Okay, so we're on the Power BI dashboard now, and before we get started, maybe just a quick overview. Starting off with this little disclaimer here that these are just estimates, and the factors may change when you try to maybe replicate this, due to things like compounding frequency, etc. So just be aware of that. But this gives a very good indication on the expected fees for each of these investments. Okay, next is just to clarify where we're at. So this is a monthly contribution of 2,500, and I just left out the actual currency. So, you know, if you're in dollars, you can work it out in dollars. And I know in dollars it's a lot for RA probably, but in rands it's very realistic, 2,500 South African rands. And I also try to be as realistic to my situation as possible. Right, so this is also increasing at 6% annually, and that's just to account for inflation. And I know this is a bit higher than inflation in South Africa at the moment, but I again also like to just contribute a little bit more than inflation towards my RA. And yeah, this is over a 40-year period. Okay, with that being said, let's get started. So just to explain each block and the sort of convention I decided to take, you have the Tom cards here, 3 of them, and the rest are all Jerry cards, right? On this little slicer that we have here. And now to explain what this means, so this is Tom, this is an average annual return of 6%, and this is assuming no fees at all. So what I wanted to do was compare like how much the fee actually takes away from this total investment, assuming no fees. So that's what we're doing, and to see what this return with no fees looks like, we'll see that over that whole 40-year period, we're sitting at about just above 12 million, less than 13, so that's 12.5 million, call it. Now let's look at that 1% fee, right, 1.19%, and see what sort of damage this does to our investment. So I bring this in. Now we'll see that all of a sudden we've dropped down to about 10, okay? And that's what the 1.19% fee, so 2.5 million, a bit more than 2.5 million already gone, just with the 1.19% fee. Now with this 3.27%, before I bring it up, just want to say that this is it's realistic, it's possible, even fees going up to as much as a 5%. And you would have seen, obviously, with my EAC report that, yeah, within those first few years, it was much more. But just over the long term, that 5% fee is very realistic. And with this 3.27%, when I saw this for the first time, I was absolutely shocked. But let's take a look at it. Now, we'll see that this basically looks like half of our original, or rather, assuming no fees. So you'll see that fees takes up, like, we're sitting at 7 million, so almost half of our investment gone, which is really, really scary, right? And just makes you think about fees when you are taking out your investments, even with a financial advisor. Okay, let's look at Jerry's side. So Jerry, no fees. And before I bring up Jerry, just a point on the fact that the decision that drives you, or rather the one that drives the decision when making investments, should be the return and not necessarily the fees, right? And this, when I show you this, it'll make sense. But remember, the no fees was with Tom was 6%, and I think this was my motivation for leaving this fund, because this was absolutely too low. And now this 13%, remember that 6% we were at 12.5 million, no fees, right? Let's see what 13% does with no fees. Same contribution of 2,500. Let's see what that does. All of a sudden, and let's maybe bring both of them up, right? So we have that one and that one, just to show you what that difference looks like. You have the one sitting at 12.5, you have the other sitting at 73.5 million over that 40-year period. And just to show also that power of longevity of that compounding effect taking into account here. But anyway, I just wanted to show you that. Very, very interesting to think about. I really thought a lot about this. But now let's just focus on Jerry. Okay, so we at Jerry here, we're at that 73.5 million. Let's see what a 0.5% fee does, which is realistic, which is actually my fee with my current RA. Okay, let's see what that does, and you'll see that, okay, not too bad. Our fee takes about give or take a 10 million, and 10 million is a lot, but at the same time, the interest, the compounding ratio that we're seeing at 73.5 million, relative to that, it's not too bad. Okay, obviously the lower the fee, the better. Now, out of interest, I decided to also look at a Jerry return of that 13%, but a Tom fee. Okay, so looking at that 1.19%, let's take a look and see what that looks like. Okay, so now with that fee of 1.19%, we'll see that we've dropped to about a 52 million from that 73 million. And again, when I saw that 3.27% fee, man, let's just no words, honestly. Let's take a look at it. You will see that our investment drops down to a 30 million So that is way more than half of our investment eaten into, the damage that it's caused. And I hope this has really awakened or enlightened you to what fees can do to your investment. Now we're just going to take a look at the allocation of fees versus investment quickly in another view. On the fee versus investment side, to see what percentage chunk the fee is taking from us. Obviously now with the Tom, no fees means 100% return, so that's at 100 you see over there. And if you look at Tom with the 1.19% fee, you'll see that it took about a 21% from us, okay, which is a lot. It is a lot, and the reason why I avoid fees of over 1%, by all means. If we look at that 3.27% fee, we'll see that that's a 45% taken off. Scary, but real. It's real. That's life. Some people are experiencing this out there. Let's start with Jerry now. Jerry, 100%. And yeah, obviously no fee taken off. If we look at that 0.5%, you'll see that's about a 13% gone. Okay, and yeah, this red slice over here doesn't look as bad as what we saw above over there, right? If we look at 1.19%, you'll see that now we're at a 28%. So it seems that as our investment grows, the fees, like the bigger the percentage chunk that's taken off, and it all plays in this compounding effect. Okay, and if we look at the 3.27%, this is a good 50, call it a 59% taken off. So that's not too shy of 2/3 of our investment gone just due to fees. All right, so that was quite the deep dive. Just in conclusion, if I could leave you with a few tips to take with you on your financial/investment journey, and that would be aware of the fees when dealing with your investment and your financial advisor. Number 2 is always ask for the EAC document. Again, EAC, effective annual cost document. Number 3 is I am not a fan of these traditional financial advisors, which I actually see as salespeople. If they are attached to a certain company and can only sell you that company's products, there is a new breed of financial advisors sprouting in the country in South Africa, and that is advisors that charge rather on a flat rate or a flat fee. So no commission based there, just flat fee on advice they give you, so they can give you unfiltered, honest advice and give you a range of products from different companies. But again, make sure you do your due diligence, make sure you understand what you're getting yourself into, do your homework, and then you should be fine. With all this being said and done, tip number 4, I think, is the most important, and that is the primary driver on any investment decision should be the returns that it gives, right? Not the fees, but rather the return itself, because I think the analysis in PowerBI proved that just having that high percentage return is the primary driver in ensuring long-term high gains. So always remember that. Otherwise, this video on more the financial side of my channel was a first. Let me know in the comments if it's something you want to see more of. This is Fintech with Kev. So this was our very first Fin part with a sprinkle of tech.